Thank you so much. Pleasure to be here.
What do you think is going on regarding the prospect of 75, the involvement of the Journal in this Nick Timiraos piece, and what that may mean about the committee's thinking?
Look, I think the prospect of 75 is very much on the table. And I think it's in large part because the incoming data, with one exception, has shown that the market continues to be very strong, overheated almost. We haven't seen what I think of people expecting, which is peak inflation. And that last CPI read, I think, really got everyone's attention. You know, I can't speak to the Journal's story. It's not the norm for FOMC members to sort of work that way. So I think it's really much more about market expectations. Having said that, I will say, you know, the move from expectation of 50 basis points to the expectation of 75 basis points has been really quite dramatic. So all eyes will be on this afternoon's meeting, the discussion, and we'll figure out exactly where we go from here. But I think it's more likely than not 100% certain, more likely than not that it's going to be 75, because that's where the market expectation is now. And when they're in a tightening mode, I think they're unlikely to disappoint the market. But, you know, we'll have to wait and see.
Right. Is there value in surprising the market to the upside, being more hawkish than we think?
I don't think there's any value in that. I don't think that's really very helpful at all. I think they'll have a chance to shape expectations by meeting the market, which itself has given them permission to move a little bit more aggressively. You know, I think the market has priced in a couple of 75 basis point moves, which seem like a perfectly reasonable thing to expect given the nature of inflation. So I think the message I think that we're going to hear is one that sounds roughly as though the market has it right now, but with the expectation that since this is such a dynamic situation, you know, incoming data may force a change in hands. Change in expectations. But I see no benefit in surprising the market whatsoever. I think it's unnecessary and would be unwise.
And Roger, there's been a lot of attention on the collective projections of the committee members here. Basically, their estimates of what a neutral rate ultimately looks like at this point, and where this cycle ends, as well as, in fact, the forecast for unemployment. I mean, the Fed Jay Powell's been pretty clear that, you know, the soft landing is an ideal objective, but he's by no means guaranteeing it. And presumably you can target job openings and say maybe it's not going to cause unemployment to go up. But that's a tricky thing to contend for the long term. Do you think that the committee is going to have to say we want the economy to soften up more here to get the job done?
I think they're going to clearly signal that. I think Chairman Powell was signaling that the last time we talked about a soft-ish landing. He said, you know, there are credible paths or plausible paths, but it would be very, very difficult. You know, I've heard him, he also used the word pain, I believe. So I think we're going to hear more of that kind of language to get all of us expecting, you know, in what I think at best is going to be a bumpy ride. And I think that's very important to get the market ready, to get the population ready. But frankly, you know, their job at this stage is to get inflation under control. They've seen, and we've all seen, the cost to average households of high and rising prices, and that is really something that is causing the Fed a great deal of anguish, as it does others. So I think they are ready to go to a restrictive posture if need be, to tolerate some pain, to use their phrase, in order to get this inflationary dynamic under control, which must be done.
Yeah, I mean, clearly the Fed seems to be operating almost as if there is a sole objective right now, which is inflation. And it is the populist one at the moment, too. Maybe there'll be a little more talk about the balance sheet strategy. And it's just fascinating to hear the discourse around what's going on there in allowing the balance sheet to shrink. Some people saying, look, this is just all abstract. It's just an asset swap. It doesn't really have real world tangible implications, the pace at which you're doing it. And other people feel like the Fed balance sheet's been solely responsible for how the economy and markets have performed in recent years. What do you think is the important message for the Fed to convey about what's going on there?
I think the important message for the Fed to convey about the balance sheet is that they have a plan and they will execute it. I think we've heard Jay Powell say that it's the rough equivalent in their estimation of a 25 basis point tightening, which is not dramatic. they will figure out where they want to stop. I think they've had some general statement there. So I think with respect to the balance sheet, it is a tool, but I actually think it's the Fed funds rate and the forward guidance that are the more important tools. We do know that as they gradually shrink the balance sheet, that is going to certainly drive some interest rates up. But I would say that's more at the margin as opposed to the actions they actually take, and importantly, how they shape expectations of the future and how the market themselves see the future.
Finally, this morning's retail sales number, first month-on-month decline of the year, a little more chatter about whether or not we're actually witnessing a negative consumption and whether or not this recession we keep tossing around may actually be in place at the moment. Do you think that's true?
I don't think there's a recession in place at the moment. It would be highly unusual given the strength of the job market and other elements of strength for sure. Yeah, but obviously, and we know this, consumers are paying the price of high and rising prices, so to speak. We see from surveys that they are moving from brands to the store brands. People are trying to drive less, for example. So we've seen a great deal of both survey data and then this retail data that came out recently that suggests consumers are changing their behaviors and trying to economize in the face of this inflation that they're confronting, which is, I think, very much the way the Fed is going to interpret this. I do not see this as a sign that we are in a recession at this stage. The other point, obviously, is interest rates are still negative territory, relatively stimulative compared to inflation. So real rates are nowhere near contractionary or even neutral just yet. So it'd be highly unusual to have a recession emerging against that backdrop of very tight labor markets, wages that are still increasing somewhat, though below inflation, and the stance of monetary policy, which has not even moved to neutral yet.
Right. Roger, that's a good look at what we might get later on today. Really appreciate it. Good to see you. Roger Ferguson joining us this morning.
Thank you.
Be sure to tune into Closing Bell Overtime to get Double Line's Jeffrey Gundlach's Fed decision reaction, of course, after his tweet yesterday, Mike, arguing for a rapid move to 3.
Yeah, certainly not a prediction, but what he thinks maybe would be the quicker way to get to where they're going. We'll see what he has to say about after the meeting. About an hour into trading right now, the Dow is holding on to about a 300-point gain. We're bouncing off of a rough 4-day stretch. S&P down 10% in that period. Let's bring in Art Cashin, UBS Director of Floor Operations. Art, good morning. It's great to speak with you. There's a lot of talk going into this Fed decision today. That unusual setup, to say the least. Rarely have you seen the Fed hiking into a drawdown in the stock market such as we've seen so far. So clearly investors are apprehensive about this. What's your assessment of how the market's absorbed it so far as it tries to get a little traction today?
Well, I think the markets got all excited. A lot of the pundits started talking about the need for a 75 or 100 basis point move. So the Fed, I think, felt it had to move, and therefore I believe it purposely leaked the idea that they're going to go for 75 basis points. Now, the reason, being an old fogey, I can tell you, the reason I believe that is back in 1994, the Fed surprised the market with a 3/4 of a point move, and it caught the general market so far off base that Orange County, California had to declare bankruptcy, and that was a major event of the day, kind of like long-term capital management. And I think some of the old-timers at the Fed said, Mr. Powell, we can't go in and shock, and I think Mr. Ferguson was right about that. The market does not want to shock here. So I think they purposely leaked it, and it got out there. I do disagree slightly with Vice Chairman Ferguson in that I think the balance sheet tightening is important, and I think what you're seeing, even around Bitcoin, around the cryptocurrencies and Bitcoin, is the concern that we're getting a liquidity squeeze here. And the fear is that while we can hear what the Fed wants to do with rates, yeah, they're going to hike 75 basis points, 50, whatever, nobody's telling you exactly how much tightening they are doing. And one of the most helpful things that could be asked of Powell this afternoon is, have you tightened any, and how much so? Because this market is terribly afraid of a liquidity squeeze and, in the case of Bitcoin, a liquidity event, something like long-term capital management or Orange County, something that catches the other markets off base.
Yeah, obviously the extreme volatility in bonds and the widening of credit spreads, it definitely puts everybody on alert for some kind of accident. Certainly remember the Orange County bankruptcy well, Art. In terms of how stocks have actually behaved, just in terms of reading the entrails here of this sell-off, you know, we were waiting to see if that was just going to be a retest of the May 20th lows. That clearly failed. It seems like that sort of brings you back to square one and figuring out, you know, let's assess the next bounce if we get one. But clearly there was some sort of washout conditions, if not, you know, the ultimate one.
Well, you got some of those, as you aptly note quite frequently, the 80 and 90 to 1 sell-offs, but it wasn't the kind of throw the baby out with the bathwater, you know. I've been around long enough. You watch to see how desperate the selling is. It's desperate when you sell what you can sell, not what you want to sell. You're cut off at that point. You sell whatever you can sell, including your grandmother's necklace. Now, I think the rest of the day, history will show us, tell us anyway, that on a Fed day like today, we should have a mild upward drift in the market, right about where it is now, hanging around there till about 2 o'clock. We'll get the announcement. We'll have about 10 or 20 minutes of frenetic whipsaw trading up and down as they're trying to assess any little bit of that statement. And then we go to 2:30 and Powell. And the key for him will be to tell people to pull a Mario Draghi and say, we're here to do whatever it takes, and that will be done. But hopefully, maybe Steve Leisman or one of the bright people in the audience will have the courage and aptitude to ask him, have you tightened yet? And if so, how much? Because that's an underlying concern, not only here, but in Europe. That's why the ECB had an emergency policy meeting today, because you started to see Italian bonds were up to 4%, Greek bonds are beginning to move. You know, that whole Mediterranean sector, it's all about liquidity. Everybody's terrified that liquidity is disappearing, but we don't see it. We can't feel it quite yet. So the Fed's got to begin to tell us what they're doing about that tightening.
Art, as far as equities go, we had you on in the midst of the May sell-off, May 9th actually, where you said if you could get 90% down volume and the VIX to 40, I'd throw my hat in the ring. But unless you put those two things together, you got to be a little bit suspect. We definitely got one of the two. How do you feel about that combination of tells right now?
Well, again, I'd like to see that the VIX spike above 40. People tell me there are certain nuances here that are inhibiting it, and the fact that it has not gone back to 20 or the high teens, and therefore that spread is not there, that you may have to go all the way up to something like 45, that you need a big spike. But until they start selling grandma's necklace, Carl, I'm not ready to jump in quite yet. I think the key is today, as I say, we expect for an upward move. If we roll over, watch 3,700. They break that. That could cause some problems. I tend to think that the bottom could be around 3,500. But again, it's an off-year election. Traditionally, the bottom in an off-year election comes later in the year, around August, September. I don't want people biting their nails until then. But so I've got things that seasonality telling me on one hand might not be here now, and on the other side, that fear of liquidity and grandma's necklace. So you got to stay tuned.
Yeah, it's certainly a low is not always the low, no matter how it goes. Art, thank you very much. Great to talk to you.
My pleasure.